In the world of high finance, most people hear about private equity firms buying billion-dollar companies, restructuring businesses, or generating massive returns, but what 99% of investors still overlook is the growing revolution inside the industry itself: GP stakes investing. This full story begins with Michael Rees, a pioneer who saw something others couldn't see. While the world focused on investing in portfolio companies, Rees was studying the structure behind the structure, the private equity firms themselves. He noticed that these firms were rapidly growing, expanding globally, and generating predictable fee streams. Yet nobody was truly treating them as investable assets. This meant that an entire universe of value was hiding in plain sight. Rees saw the opportunity not in owning the companies these firms bought, but in owning a percentage of the firms doing the buying. He realized that private equity managers had recurring income, strong performance histories, and reliable incentives to grow. Still, for decades, no one had thought about offering them capital in exchange for a slice of that long-term upside. And that gap, buried deep in the engine room of global finance, was where he would build a multi-billion-dollar idea. His thesis was simple but groundbreaking: if you could partner with financially strong, high-performing general partners and support their expansion, their entire platform could grow faster, deliver more deals, and build more assets under management. And since fees are based on those assets, the cash flow could compound year over year. Rees didn't just follow a trend, he created one. When Michael Rees first introduced the idea to major institutions, almost everyone dismissed it. Investors were comfortable backing funds, not the fund managers themselves. The industry wasn't built for transparency, and many believed GP stakes investing would interfere with independence or governance. Critics argued that private equity firms would never give up a share of their management company. But Rees anticipated this resistance. He understood that these firms, despite being extremely profitable, often lack long-term capital to expand platforms, hire talent, launch new strategies, or make necessary acquisitions. He saw that founders were aging, succession planning was weak, and demand for permanent strategic partners was rising. So he built a model where his firm offered non-control, minority stakes, allowing managers to maintain decision-making power while gaining capital to scale. This was the breakthrough the industry didn't know it needed. Rees structured deals to be aligned, long-term, and supportive rather than invasive. Slowly, leading firms realized this wasn't dilution, it was acceleration. They could grow faster, enter new markets, build credit and real estate arms, and compete with global giants. Once the first wave of respected managers signed deals, the narrative changed completely. What started as a strange new idea suddenly became one of the most desirable forms of strategic partnership in modern finance. As GP stakes investing expanded, the economics behind it became clearer and more compelling. Private equity management companies earn two primary revenue streams: management fees and carried interest. What makes these revenues so powerful is their durability. Management fees are steady, recurring, and often increase annually as assets under management grow. Carried interest, performance-based profits, creates massive upside potential. By owning part of the GP, Rees's strategy allowed investors to participate in both. Instead of waiting for company exits or relying on unpredictable markets, they were tapping into the long-term financial engine of the industry itself. This meant they could benefit not from one fund, but from every fund the GP would launch in the future. The model had layers of compounding built into it. The more assets the GP raised, the more fees they collected, the more talent they hired, the more deals they executed, the more strategies they launched, the more diversified their income became. And since GPs often lock in capital for 10 or more years, the cash flow streams became almost bond-like in reliability. Rees understood that the world of investing was shifting toward long-term, predictable, yield-rich assets, and his strategy delivered exactly that, but with the upside of private equity rather than the low growth of traditional fixed income. The true genius of Michael Rees's approach wasn't just financial engineering, it was relationship building. GP stakes investing requires trust, alignment, and deep cultural partnership. Rees's team spent years understanding each firm's vision, leadership style, and strategic goals. They didn't just write checks, they became architects of growth. Many GPs needed help expanding internationally, entering credit or real assets, upgrading technology, or improving operational efficiency. Rees brought infrastructure, analytics, industry connections, and institutional credibility. His message was simple: we are not here to change your strategy, we are here to amplify it. This opened doors that had been locked for decades. Founders who once believed in total independence realized that partnering didn't mean losing identity, it meant gaining scale. Firms that had plateaued suddenly had the capital to hire world-class teams. Younger partners saw a path to long-term ownership and succession. And limited partners, the institutions that invested in funds, began viewing GP stake-backed firms as stronger, more professional, and more stable. The ripple effect transformed the ecosystem. The more partnerships Rees created, the more the industry validated the strategy. As the model matured, something extraordinary happened: competitive advantages began multiplying. GPs with strategic capital partners raised larger funds, closed deals faster, attracted better talent, and expanded into new asset classes. This created flywheels of growth. A firm strong in buyouts could add growth equity, credit, real estate, and secondaries. Each extension increased assets under management, which increased fee revenues, which increased enterprise value. Meanwhile, the GP stakes investor continued participating in all future growth without needing to inject more capital. This is why the returns were so compelling, not because of one-time wins, but because of perpetual participation in a growing financial machine. On top of that, GP stakes investing offered diversification across dozens of top-performing managers. If one strategy underperformed, others compensated. And because private equity firms typically operate with high alignment and performance discipline, the downside risks were far lower than traditional corporate investing. Rees predicted that as the industry globalized, the demand for permanent growth capital would explode. He was right. The largest firms in the world, the ones shaping economic outcomes across continents, began seeing GP stake investors not as outsiders, but as strategic accelerators. Still, the journey wasn't without challenges. Critics continued to question valuation models, liquidity timelines, and governance rights. Some worried that minority investors might push managers in unwanted directions. Others argued that the strategy benefited founders more than limited partners. But every emerging industry faces skepticism before it reaches maturity. Rees responded with transparency, data, and consistency. His deals emphasized long-term alignment, not short-term gains. He showed that stable ownership improved firm quality, reduced operational risk, and ensured continuity across generations of leadership. He highlighted that GP stakes investing wasn't about extracting value, but creating value by helping firms expand their capabilities. Over time, results spoke louder than theory. Firms that partnered with GP stakes investors grew significantly faster and delivered stronger investor loyalty. Institutions saw improved governance, better reporting, and more professional structures. And the model proved resilient even during market downturns because fee-based income remained steady even when deals slowed. Today, what was once controversial is now considered a mainstream asset class, and Rees's role in establishing that cannot be overstated. What most investors still don't understand is how early this movement truly is. Private equity as an industry continues to expand globally, with trillions in assets yet to be raised. Hundreds of successful mid-market firms lack capital for growth, modern infrastructure, or succession planning. GP stakes investing is positioned at the center of all of this. Younger firms will need expansion capital. Established firms will seek succession solutions. Global platforms will require partners to launch new strategies. And institutional investors hungry for yield, stability, and long-term exposure will increasingly look toward GP stakes as a solution. Rees's vision created a roadmap for this future. He proved that investing in the managers shaping the world's capital flows is one of the most powerful ways to participate in global economic transformation. Instead of betting on individual companies, he invested in the architects of capital, the decision-makers who determine which companies thrive, scale, merge, or innovate. This shift in perspective represents one of the biggest financial insights of the last 2 decades. Today, the full story of Michael Rees in GP stakes investing is more than a financial case study, it is a lesson in seeing value where others see none. It teaches that innovation doesn't always come from new technologies or exotic products, sometimes it comes from rethinking something familiar. Rees looked at the private equity industry and asked a question nobody else asked: why invest only in what the GP buys,
when you can invest in the GP itself? That simple idea unlocked a multi-billion-dollar opportunity that now influences the entire asset management landscape.
His model empowered firms, strengthened founders, increased stability for investors, and built partnerships that outlast market cycles. And for the 99% of investors who still don't understand GP stakes, the message is clear: the most powerful opportunities are often hidden behind the curtain, where only those willing to study the structure, not just the surface, can see them.
The story isn't finished. As the industry evolves, the firms with strategic partners will dominate the next generation of global finance.
And those who recognize this shift early will be the ones who benefit from the compounding engine that Rees saw long before anyone else.